Do you know Martin from?
Mati?
He was previously from RAPR. I read your story over the weekend, and you wrote this story on small caps with growing dividends, looking for small caps. So, and then you selected 10 companies from the Bursa, from the main board, and includes Sen, Engineering, Asia File, and all that. Now we understand that it's too expensive for us to buy stocks like Bursa or FGV or Nestle, and alternatively, we look at all these kind of stocks. How do you actually select these 10 stocks, and what kind of criteria are we looking at?
Because we are looking at small cap dividend growing stocks, so by definitions we filter up stocks with more than 1 billion market cap. Additionally, we also filter up stocks with less than 4% dividend yield. 4%, which is the highest highest FD we can get in the market. Moreover, we also use 3 more criteria to narrow down our list of stocks, which is better of less than 1, ROE of more than 4.6%, and just history of paying higher dividend over the past 10 years.
Talking about dividend yield, of course it has to be higher than FD, else we will just put our money into FD. It's more stable. So what kind of range are we looking at? Beyond 4%, but what kind of range?
Based on, if you look at the table 1 in the article, it ranged from 4.1 by Asia File to 7.1 by Lihian Industries. So because you are investing in stocks, so there is a growth component in your investment.
7% is actually quite high.
Yes.
Now, surprisingly, before you wrote this story, you wouldn't expect that most of these companies, they are actually exposed in the overseas market. But when you came up with the chart, some of them, they have large exposure to the European market. Some of them, they export to the US market. So does that mean that companies with more exposure to the exports market, they are doing very well, they are giving out good dividends as compared with those with local exposure?
Well, it does not necessarily mean that dividend stock must be export-oriented stocks. It just happened to be when we narrow down the list, we noticed that a lot of them are export-oriented stocks. But it makes sense anyway, because export has been the proven way for the country to create wealth, and particularly so in Asia.
But the thing is, because of their size, market cap is not huge, it's not fantastic. Most of these stocks, they are illiquid. So let's say for example, if I want to go in but the stocks are liquid, how am I going to chase for these stocks?
That's the problem with small cap in general. Because of that, investors must bear in mind that and be prepared to hold the stock for a longer period of time compared to the liquid bigger cap stocks.
Now, we look at the biggest one in the list, which is Sen Engineering and Equipment Berhad. They are in the aerospace industry. But the capex, they are going to roll out capex 100 million for the next 2 years. When I look at the net profit and revenue, it actually came down 26% for net profit. Should I actually be worried? Let's say, for example, I have some stocks in this company.
Well, I would say generally the outlook is still quite positive because of the 3.5 backlog of contracts they need to execute over the next 2 to 5 years. So because their plants are running at full capacity, so they will need to invest 100 million to ramp up their production capacities.
So it's a long-term growth for this company?
Yeah, over a longer term is rather positive, despite the downturn in the 1Q result.
So for smaller investors like us, we wouldn't have the kind of money to pump into Nestle or I don't know, Dutch Lady. So if I have this X amount of money, 5,000 ringgit, I want to put it inside the main board Malaysia, Bursa Malaysia. So what kind of stocks can I look at out of these 10 stocks?
Out of these 10 stocks, I would say if they are all with decent, if not attractive dividend yield, and it's really up to individual preferences. If you want more growth components, we can perhaps consider Sen Engineering, which has a very high earning growth visibility. If you prefer stable dividends, you can perhaps consider stationery product maker Asia File, which is in a very stable, mature industry. So you could expect relatively stable cash flows.
Okay, so just now we talked about companies with huge exposure for the overseas market, and now we look at some of the companies they have more exposure to the local industry, like Perstima and Hexa, Perstima and Chinwell. They are in the steel market industry in Malaysia. So what kind of growth are we expecting from these two companies?
Well, if you look at the past 5 years historical data, the revenues are not growing very a lot. But because of the soft steel prices, they've been enjoying a windfall from the soft steel prices. So you can see the earning has been growing in the past 3 years, I would say.
So, of course, Lihan Industry as well, they are another company that rides on the strengthening of the US dollar and also the very strong demand from the States. That's why we actually saw a spike from their net profit and revenue. But do you think it can last for, say, for example, for the next 2 to 3 years?
Well, it's very hard to predict macroeconomic events, especially if they are shock in nature. But overall, the indicators are rather positive in the US.
For more on the stories, pick up a copy of The Edge Weekly at all good newsstands.